Rocket, with the acquisition of Mr. Cooper, will be servicing $2.1 trillion of loans. That is 1 in every 6 mortgages in America.
I think there's a little bit of room for the mortgage rate to come down even between now and the end of the year if the 10-year Treasury stays where it's at, and especially if it continues that trajectory, downward even more.
Episode 37 of Market Moves with Mark and Jeff. 2 uninteresting guys talking about interesting times. Jeff, coming live to you from San Antonio, Texas in the AXE conference. Tell us a little bit about what's going on here.
There it is. I'm afraid that tagline is going to stick, but we may as well wear it with pride at this point, Mark. Yeah, fun to be together. We may have somebody walk in and interrupt us while we're trying to do this in a public space, but been a lot of fun to connect and meet with a few people that have been positive about the podcast. So really appreciate, that feedback as always. But yeah, as you said, here at the AXE conference, San Antonio also happens to be the weekend of the Final Four and championship basketball games for the men's NCAA tournament, which has been kind of fun. My bracket was laid to rest a while ago, unfortunately, but as with most at this point, I suspect. But yeah, so it's been a good time here connecting with some people. One of the staples of the AXE conference is to try to provide some opportunities, educational and otherwise, for trainees and aspiring trainees, those interested in becoming appraisers. It's a special breed sometimes of people that want to get into this profession. But one of the things we did that was kind of fun, and kind of first time ever, was we took a field trip and kind of titled it that specifically. It felt a little bit like being responsible for a kindergarten class going out in the field somewhere. But we had arrangements to go to a builder's new construction site. Pretty cool experience, able to demo some apps for measuring homes in the field, learning a little bit about new construction for those who just haven't been in the valuation space for very long or at all. But one of the things that stood out to me there, Mark, was just some of the advertising that's a real shift from what we've seen in the past of people desperate to buy homes and bidding them up. I saw a sign sitting out front of one of these vacant homes that the builder had offering 4.65% interest rates, just kind of underscoring or highlighting what we've been talking about for a while of how builders are providing incentives to move inventory. We shared a screen, I think, or a chart last week from Lennar with their incentives up, I think, at 13 or 16% of the sale price. And so as they buy interest rates down, it makes things affordable for the housing. In fact, I've got a chart I was going to share for just a second. It's kind of interesting for anybody watching on YouTube. If you're not, the kind of summary is there's a real spread between what at median home pricing and at the current interest rate, what you have to make in income to qualify for a home. This chart by Charlie Bellelio, I don't know whether I said his name or not right, but he's cited here anyway. It shows a needed qualifying income of around $125,000 at current median pricing and interest rates. But the median actual income in the United States closer to $80,000. So you've got $40,000 spread between what you need to qualify versus what is the median that you're actually seeing in the market. And so that reality is driving the builders to say, we've got this inventory we need to unload. We're going to buy down that rate, which narrows that needed gap to kind of a below market interest rate. And just interesting to see what steps are being taken to help drive affordability.
Yeah, it's this chart does highlight that, and what you feel sort of innately as you're watching the market, certainly as you're driving through. And these builders their whole MO is to serve the income gap that exists here in non-new construction and existing homes. And so they have built like mad into this low inventory space where prices have gone up a ton, and the median price of a home is way above what it used to be, and you've got high interest rates. So they're building in. I think I saw preparing for a presentation yesterday. I saw that new construction sales are typically on a national level about 14% of the total marketplace. But over the last year or two, they've been between 30 and 40% of total sales around the country. They're just wild, and builders are just feeding into that. And I think that it seems to me that the affordability gap that they have been trying to meet has widened a bit. And so these concessions, and now concessions plus lowering of sale prices are what's necessary to meet the borrower to get a sale.
Yeah, that's exactly right. And, like anybody participating in a market, they're finding ways to, move the inventory that they have. In part of your presentation too, you were highlighting that they're still leaning into the building and bringing this stuff on, which is interesting, and was a little bit what led up to the overbuild last time. Now, if interest rates drop, and we'll kind of touch on those in a minute, there's just a lot of forces to where I wish I was better at predicting, where the market is headed than I am. But we are seeing, at least in the moment, the data is that they're not showing signs of a significant pullback in the inventory they're bringing online.
You bet. Well, a couple of quick programming notes. So Jeff and I, while you can't tell here, are about 2 or 3 feet from one another for a rare moment, because we both are at the Axe Conference. Props to my U of H Cougars, who pulled off a miraculous semifinal win and are playing tonight here in San Antonio. Also, another busy time, the Valero Open, I think leading into the Masters coming up pretty soon here, is in San Antonio also. So there's a lot going on here. We had good fortune to get hotels.
I think you in particular. I'd at least booked mine a while out. So glad to be here, and pardon any interruptions that may come up as we're recording.
Yeah, absolutely. Well, very good. There's just so much going on. It's been a little bit since we've recorded. We missed our standard Thursday recording and a recording Monday morning here. And enormous news last week. Well, there's enormous news it's 2 uninteresting guys talking about interesting times. And we have Rocket announcing the acquisition or intended acquisition of Mr. Cooper. My goodness, is this a big one? And this is just on the heels of the announcement of the acquisition of Redfin, which really had people sort of on their heels and identifying that the mortgage market generally is changing tremendously, with vertical stacks kind of being acquired by mortgage companies. And there's kind of 3 pillars. There's home search, there's origination, and then there's servicing. And their acquisition of Redfin was kind of getting into the home search or expanding on it. We saw during the Super Bowl ads that Rocket was putting out there. I forget what it was called, but it's like a personal finance app, right? So it's trying to help people get prepared to buy their first home. And so then they move into search. And so they are really trying to own that space. On the contrary, you have Zillow. Zillow has been the home search king for quite a while. But what did they do? Or maybe undercapitalizing the leads that they're getting from folks that are coming onto Zillow and looking for properties and communicating through clicks what their intentions are and how serious they are about buying. But they've done, I think it was $7 billion of mortgage loans now last year. They bought a modest mortgage company by Rocket standards, at least, and are trying to add origination to that first leg of the stool, which is home search. And so it's quite amazing to watch this. And this is an interesting expansion of scope for companies, not just in mortgage, but all over. And it's not just, but I think folks like Tesla, you see the Silicon Valley perspective. I've been on several capital investor calls, private equity, and those sorts of things, always having those calls just to keep up with folks. And, there's just a real transformation there that, I would avoid any sort of lower margin or hard work if I'm a software company, because I don't want to give up any software multiples. Or mortgage, I'm originating, that's where I make my money. I'll let others do that other stuff and partner and bring in. Well, there is a real charge to try and control the entire vertical. Stats about this. It's really pretty amazing. So Rocket, with the acquisition of Mr. Cooper, will be servicing $2.1 trillion of loans. That is 1 in every 6 mortgages in America. It is also true that Rocket has an 83% recapture rate, which I interpret to mean that the folks that Rocket has made a loan on, they will then refi or do their next loan when they go to buy a new house or whatever. And that 83% capture rate is triple the industry average. So they have this flywheel of keeping the customers that are coming in, and they have just acquired 7 million new customers. And that 2.1 trillion that they are servicing. Just as an aside, Fannie Mae is the 4th or 5th largest company in the world with their $4.3 trillion in assets. So Rocket, a private company here, is half of that in servicing. That in the marketplace.
Boy, it really is, Mark, and it's just interesting to see this big play, coming together. As you talked about the 3 verticals there, and I was really surprised to see that their recapture rate is what it is. But then you go acquire this whole new line of servicing that they have, and I do wonder a little bit if how much recapture they may have on this big acquisition, where the loan wasn't necessarily originated with them. I think Rocket, being the direct to consumer kind of a retail channel, has focused and it clearly is excelling at once they get the customer, retaining them. But even still, it gives them access to start marketing to, I would guess, a lot of these that they now have in servicing through the Mr. Cooper acquisition. And big, it really moves them into a space of, being on par at some level with the Fannies of the world, and changes, I imagine, a little bit the dynamics as they're negotiating or service or selling to Fannie on the stuff that they originate as well.
The 2 big players, the mortgage wars, is sort of fun to watch from an innocent bystander perspective. But what Rocket has gone towards and is excelling in is what I think it's 64% of the total market is the retail mortgage origination, where they are originating the mortgage themselves, where UWM on the other side of the mortgage war has dominant control of the broker side of things, or the broker channel, which is, I think, 36 or 35%. I could be off just by a little bit there, but it's really interesting to see how these 2 behemoths are going at the market.
Yeah, it really is. And as you think about the mortgages that you've gotten, or people that I know when I've gotten mortgages, there are these 2 different ways to go about it. I see some ad on the Super Bowl or something that Rocket puts out, and reach out, fill out an online application or whatever. I mean, that appeals to a certain contingent of people looking for a mortgage. But there are many others that have a friend, a family member, an associate, or have just seen marketing from a local mortgage broker that happens to be in the neighborhood they have a relationship with. And so any who are working with a broker are much more likely. Now, UWM is not the only wholesale channel that a broker may originate the loan through, but they're the biggest one, and they certainly their marketing is to the mortgage broker community. And I know a number of just local brokers, friends and stuff in a group that I'm in and otherwise. And UWM has had them back on site, in the facilities in Detroit, and doing some education. And it's a real interesting marketing push to a different way of bringing the mortgages into them through the brokers as opposed to direct to the consumers. But this acquisition, is definitely a bit of a game changer in what Rocket brings in terms of overall size and reach.
So then, Jeff, we have enormous news with Rocket acquiring Mr. Cooper, and that is almost just a fine print of last week's news as we reach the dreaded can you have dreaded and liberation in the same sentence? I don't know, but maybe you can. But we have the April 2nd Liberation Day as defined by the administration. But we have enormous tariffs, the largest tariffs that anybody was prognosticating are laid out and implemented on April 2nd. Over the last month, we have seen the stock market drop 12%. In enormous in just the last few days, and people are panicking a little bit. And I guess, talk a little bit about, you and I are a week into being true experts on the subject of tariffs. Jess, what do you think? What do you see?
Boy, so interesting. And in fact, it's interesting to hear you talk about people panicking a little bit. My wife listens to this podcast, so I have to be careful about like how I describe some events, as you can imagine. But it was funny. We're traveling to the ACTS conference. I had a bit of a layover, delayed flights, and all that fun stuff that comes with traveling. But was sitting in the airport and talking with my wife on the phone for a little bit, and she made a comment about, well, I checked my work 401k and it's still there, like it hasn't disappeared. It kind of, not that she really expected that that's what would have happened, but it hadn't had as big of like a net effect as it might have been, or what some of the prognostication out there would suggest that it could have been. Just in terms of the stock market move and what does that do to people's retirement savings, or if you happen to be invested in the stocks. So there is definitely some movement, and I think there could be some events that may lead to some compounding effects that might result in even more movement in stock prices and that sort of a thing. But you were commenting that talking to some of the people here at the conference that are just looking at getting into the space, even they were worried about like direction the stock market's going, whether they have any like direct financial investment in it or not.
Yeah, it is certainly panic time, and I see a lot of that. Change makes people panic. We're feeling that in the appraisal and real estate spaces with changes, to real estate commissions, with appraisal waivers that we've talked a lot about. There's just change everywhere, artificial intelligence and all that. And I think this sets enormous shock. I am not a trader in the market. So, I'm in the stock market, but it is a long time horizon sort of thing. And, I don't necessarily have a 5-year outlook concern. I have maybe 10 or 15% chance of some real ugly economics over the next year and a half, but it won't really affect what I've got, how I look at things or personal security. Now, if business slows, I think that impacts me much more than the enormous stock market collapse. And Scott Bessent, who we talk a lot about on this podcast, has been going around this weekend talking about how it's amazing stats that 80% of the stock market is owned by the top 10 or 12% of America. And it's like 90% on the top 40. It's the point being that America generally, the majority of Americans are not in the stock market. And this is, I think, largely the policy of this administration, or it's like, look, our voter base are not people in the stock market. In the stock market has been propped up by all of this government stimulus for so long. The big MAGA stocks, the Metas and the Facebooks and the Metas and the Amazons and Googles and whatnot. And so I think they don't mind some of the hit here because that isn't hitting their voter base. It is returning jobs to the country is what their primary focus is, along with getting interest rates down for the refinance of some major debt that we have coming.
Yeah, that's exactly right. And to that point, one of their other stated objectives is to help improve housing affordability, which isn't necessarily what you want to hear if you own a big portfolio of real estate. That they want to drive values down like that. That doesn't sound or feel good in the real estate space, just like with the stock market space. But I to your point, Mark, I think that is their stated objective, is we want to improve things for the average voter, not necessarily the very top in the space, whether it's the stock market or in real estate in terms of ownership. And so, the actions they're taking are moving towards what their stated objective is. You can love it or hate it or feel any differently about it, but we're kind of observing and commenting on what we're actually seeing play out, and what they're saying they want to accomplish, that the actions seem to be moving that direction, and at least seems to be a real effort to make that happen.
You bet. And you see, Jeff, sometimes we will throw out opinions or predictions. We don't know. And I do think we have a pretty good track record on market moves so far on the 3 or 4 projections or predictions that we've made so far. And I would predict that where this ends up and where the administration wants it to end up is roughly a 10% tariff around the world, and that they this is, for whatever reason, the methodology they think is necessary to get there, the shock to get people to the negotiating table. So it's really interesting. In one of the criticisms as the silly little reciprocal charts came out, and people are making fun of the crazy math, I guess, or oversimplified math that's being used. That is defined as reciprocal, but it isn't what most people would think of as reciprocal. But it was like, hey, why are you tariffing to oblivion these Asian countries out that are alternatives to China? You've got major corporations that have set up away from China and moved to places like Vietnam, and that is to lean off of dependence from China. And why are you doing that? You're discouraging that. And you saw Vietnam come to the table and say, hey, we'll eliminate tariffs entirely, and really position themselves for this new world order in a really strong position. And I don't think the administration's responded yet, but what an interesting time for an opportunity for some places to really raise their standing on the world stage.
Boy, it really is. And the thing that's hard to know is this a lot of big headlines that kind of fizzle and you go back to business as usual, or is there really this reshaping of kind of a world order, like you say, Mark? And you and I have both listened to a number of the people around the president, long form interviews that they've done and that sort of a thing. And whether right or wrong, I mean, it will play out one way or the other. I think there's a real investment. I think there's a real belief that this is the way they think that things should be going. And I think it's a commitment. I don't think it's bluster. I don't think it doesn't seem to be, well, we're just going to threaten these tariffs, impose them initially, and then roll them all back as we try to negotiate some marginally better, trade arrangement or agreement. Now, maybe that plays out, but I don't think that seems to be the actual fundamental belief of those in the administration. And so this reshaping of how trade is done between the U.S. and all of the other partners and countries out there, I think is more likely to be more significant, from a historical perspective when you step back and look at it, than what some have been saying leading up to this of, well, it's just a negotiation tactic, and at the end of the day, it's just going to be a minor marginal change. I think it's going to be more significant than that. We can add that to the prognostications we've made and see if it plays out or not. But
yeah, it's interesting. A lot of the guys of financial prominence that you and I kind of watch what they say, read what they put out there, the Bill Ackmans, the Brad Gershners, these sort of Silicon Valley types that have really gotten into the Trump camp and been very supportive of everything he's doing, are not supportive of what they're doing right now. They think it is reckless, and you can imagine that they're managing money for a lot of people, and not liking the calls that are coming in. But our one of the foundational podcast listens for market moves is the All In podcast, and Chamath, one of the four besties, I guess they call themselves, has was in January predicted something really interesting, and this ties back to the great financial crisis and The Big Short. If everybody has seen that movie, kind of recounting some people that saw, when no one else did, the calamity that was building up, where terrible mortgages were made at large, pulled up, and then sold as if they were great mortgages. And just sort of by fact that there's a whole bunch of terrible mortgages into a pool, that means the risk has somehow been alleviated. And so there were people out there that said, hey, I see that if just 5% of these mortgages start falling apart, and it looks like they are, that I can make enormous insurance bets against those large pools of mortgages and make a killing. And so people like Michael Berry did that. Well, Chamath in January, knowing that some sort of a tariff thing was coming with Trump taking office, says, I think the best asset class may be CDS, which stands for credit default swap. And this was the sort of instrument that the Michael Berrys of the great financial crisis used to bet against mortgage-backed securities, CDS. So his point was that if Trump implements hugely large tariffs on other countries, it is going to totally disrupt American companies, certainly that deal on an international scale, but also those that rely on imports to build their products. And what he knows is that that all or most business loans have covenants in them that are tied to EBITDA or revenue. And so if large tariffs are sitting there for a long period of time, months at a time, it is going to cause those covenants that are requiring a certain level of EBITDA or a certain level of revenue to not be met any longer. And those are in default at that point. And then what happens when that happens? And so you could buy these credit default swaps, these CDSs, to bet against these business loans that are out there. And so this week he was on a pod. It was fascinating to me. He was showing that for every $1 million that he or someone would have bet in January, that it is so far returned $7 million of return. Those CDSs have risen by a 7x. And he is suggesting that it's possible, hopefully not, and maybe likely not, that could 1000x if things really got off the rails. And so I think this is one example that highlights the gamble and the risk of the high tariffs that are out here. It is, I think a lot of folks see that and are quite concerned.
That makes sense. And it's just so similar in some ways to, as you talked about the great financial crisis. We have this massive housing collapse, people betting against it, seeing that, hey, this doesn't seem sustainable. Everybody in the world is talking about owning, 2 or 3 or 4 spec homes. They're getting loans, under very weak credit and kind of income verification scenarios. Something's probably got to give here. Well, it turned out that it did. And those betting against it won, in a very big way. And this, seeing businesses highly leveraged with lots of debt, any weakness in their ability to preserve, whether it's revenue or earnings, through EBITDA or whatever, it may not take much for there to start to be this cascading effect of kind of weakness that then ripples through the business economy. And again, it comes back to the administration, whether you agree or not. Again, they're saying, hey, we're okay with some of this pain that may unfold, and it's starting to happen. I do have to say, as an aside, Mark, that you and I have probably gotten lucky on a few prognostications. I was literally talking to somebody here who said, yeah, I heard you guys talking about the Fannie Mae stock and the stock price, and if they go private, it may go up, and reached out to like their IRA provider and wanted to get some in there. I was like, sitting there thinking, holy crap, we're really not qualified to be giving investment advice. It seems that, making a bet on some credit default swaps is probably not a bad bet, but I will just say, invest at your own risk. Mark and I are not coming to you from, our mansions having won big by betting on stuff and being able to predict the market well. But there are some, you start to see some of these kind of converging trends, and it definitely makes, logical sense that we're probably on the very front end of what could happen if that scenario plays out. Tariffs drive costs, impact income and revenue for businesses, and then you start to have a lot more defaults there. It's consistent with the administration's comfort level with allowing there to be pain to meet their objectives, but it's playing out. I wish I was as good as Chamath at seeing that stuff well in advance. But it definitely makes sense the way that it's been described and is playing out so far.
Yeah, that to me, Jeff, when I heard the prediction in January, it just resonated. Man, that does make sense, and I'm certainly well aware that those covenants exist in business loans, and so I can see in almost every case it's kind of non-negotiable. It's that is the requirement of the loan. So interesting. Well, so we look at these tariffs and the hit to the stock market. And taking this back to real estate, but also, national economic health, interest rates on January 13th of 2025 were 4.78%. This is interest rates, the 10-year Treasury, Jeff. Today, they are at 3.97%. And when Trump was taking office, there was conversation, man, we might see rates up to 6% or something, and we may still get there. I don't know. It may go kind of haywire, but this is a very meaningful drop in the 10-year Treasury. You saw the president quickly going out and requesting that Jerome Powell, not so friend of the pod, drop interest rates as a result of this. And he said, oh no, we're prepared to stay steady for a long time here. So there's a little bit of a cat and mouse going on. But on the national stage where we have something like 36 or 35 trillion dollars of debt, 9 trillion of that is coming due this year. And that's a real big concern considering our enormous deficit. And I was just kind of trying to go through with Grok, leading me through understanding, what that sort of 4.78% down to 3.97%. People often use the 10-year Treasury yield as kind of a placeholder for what we could borrow at. The government doesn't borrow at a single interest rate. They sell bonds or CDs or whatever it is to fund this sort of stuff. But that 9 trillion refied at that dip from 478 to 397 is roughly a $73 billion a year savings. Now, what is that? That's roughly about 1.1% of the overall budget. So it's not a total game changer, Jeff, but it is 5% of the deficit as it currently sits. So that's pretty meaningful. And $73 billion a year covers the entire Department of Education budget or NASA twice over. So these are not small dollars that we're talking about here. And I don't know if we're at the end of a drop one way or another. Feels like maybe the Fed dropping could help that some, but we're seeing good movement.
Definitely are. And of course, if you just get rid of the Department of Education, then the savings is doubled over, which they've also talked about. Now, who knows whether that happens or not, but really interesting. And as you were kind of laying out what the 10-year Treasury has done since January, it's interesting to note that the mortgage interest rate hasn't followed as much. It's also come down some, but it hasn't had the same percentage amount decrease, since then. So just kind of coming back to what we're talking a little bit about why builders are buying down rates to help with affordability. I think there's a little bit of room for the mortgage rate to come down even between now and the end of the year if the 10-year Treasury stays where it's at, and especially if it continues that trajectory, downward even more.
Boy, it's such an important point. I saw the 30-year mortgage rate at 6.55 or something late last week. I didn't look today before this podcast, but yeah, it's coming down because there's room for it to come down. And Jeff, I think you could see it at 6 without Fed movement on interest rate in the right set of circumstances. And that's meaningful to people. I think that gets people moving.
It really impacts the affordability of buying the homes. And if you're looking at anything other than a new home with a builder that's got incentives to buy down the rate, there's just not as much room to move. We've had this lock-in effect of people not wanting to sell because they don't want to get rid of their really low interest rate. Their ability to flex or just drop a price dramatically from what they may have paid for it 3, 4, 5 years ago isn't there in the way that it is for builders. And so again, it could have kind of a ripple effect if the interest rate doesn't give, and the only way to improve affordability is significant price reductions. We're just watching it. It'll be interesting to see how it plays out. But with relief in the interest rate, I think that should translate to less necessary movement in overall home values. And so far, the interest rate is trending that direction to where that may be what helps bridge the gap on the affordability that's missing in the moment.
Yeah, I think it was Kathy Wood that I saw on her In the Know podcast. She's with ARK Invest, and suggested that something like maybe 30% of households are concerned about their employment, moving forward here. So there is, you might have some rates coming down. There's a reason for that. There's some uncertainty in the marketplace, and it's not as strong out there economically. And, so I think we have to couple all of that together, that there's this transition happening, especially with Doge. I did look at the US debt clock here and saw that Doge is at $289 billion of savings so far, 3 months in, 4 months in. But a lot of that savings is reductions in Department of Education and HUD and, on and on, right? And so, and then you also have AI creating concerns where you have middle management at tech companies being laid off all over the place. So these are really deep and meaningful changes. But I've also seen SBA administrators coming on to news programs and saying, "Hey, we are gearing up for the private side to build and to build businesses and hire and go forth. So just so many moving parts in this.
Boy, there really are, and it's interesting to hear or be reminded of some of the layoffs, some of the movement that's taking place. I was having a conversation with friend of the pod, Scott DiBiasio from the Appraisal Institute, who's very involved with nationally what's happening in the appraisal space, but also in kind of the political space as he's helping to advocate for positions of appraisers. But one of the things he was commenting about was that there's been some layoffs touching appraisers in the Department of Interior and in other federal organizations. And I think just to that point, I mean, these policies are touching the real estate space, those in that space. Some of that stuff will then be contracted out to private companies as opposed to handled or managed internally. And that's not to say everyone's gone there necessarily, but that cutting back has certainly been touching appraisers in the federal government as well.
Amen. Well, Jeff, you had shared kind of on our podcast thread a article by Lance Lambert talking about kind of the state of home flipping and home flippers around the country. Why don't you walk us through that?
Yeah, I've got this pulled up for just a minute, Mark. And part of this is just kind of the appraisal nerd in me that comes out whenever you find a good data source for something. It's fun to dive into and think through it a little bit. So if you're not watching on YouTube, maybe you should. I'll try to articulate this as well as I can to illustrate some of the stuff that we're seeing, and welcome some of your perspective on a few of these charts as I just kind of scroll through this screen from the Fast Company. But this first chart has up how much home flipping has taken place since 2000, and you see a big spike, just right before the financial crisis. Interesting that kind of led to, or at least was a symptom of the massive change in the market at that time. We see the very similar spike coming into the COVID years and then a retreat, in the last year and a half. So whether that trend continues down or not, I don't know. But it was interesting to see how it moved forward. I'm going to scroll down to just a couple of is showing that 77% of those in the home flipping space are projecting to have at least another to do another flip throughout the year this year. Not very many that are somewhat likely or unlikely to do so. I kind of like home builders still leaning into building. I think you've got home flippers still planning to flip, even though they've been the overall number of flips is on a downward trajectory. But some things I think, and if you're interested in this data, going to the Fast Company, and you can dive as deep as you'd want to, just a really interesting data source. But one of the things, any of these data points that we'll talk about, so you're pretty consistent, but Midwest at 82% of home flippers are likely to flip something in 2025. The lowest is in the West. You'll see some weakness kind of in the West flipping market as we look at a lot of this data. Spread there is 71% of home flippers in the West are likely to do a flip in 2025. So a bit of an interesting trend there. Really interesting to see how many home flippers are doing flips. 65% do 1 to 3 in a typical year period. 16% do 4 to 6. Just kind of interesting to see the mass majority of people out there doing home flips are smaller scale, so to speak. There are only 13% of those in the home flipping space that were doing more than 10 in a given year period of time. Again, kind of the breakdown between the regions, West again being the shortest there. There was one other that I thought was interesting. The timing to do a flip, 82% of home flips take 6 months or less to complete. Kind of interesting. The thing that what I think was maybe most interesting to me, Mark, was the expected return on investment for different flips in different parts of the home. Kitchen upgrades. Whenever people ask an appraiser, what can I do to increase the value of my home? Well, kitchen remodels, repainting, flooring, bathroom. I mean, those are the things that really tend to drive the values. And was interesting to see what the anticipated return is on those. 56% return on kitchen upgrades, 6% return on bath remodels, 11% on flooring. Just kind of interesting. Other cosmetic updates, 18%. Just an interesting data point there. There are more I think we could scroll through, but those were a few that kind of stood out to me on it.
Yeah, fantastic. Yeah, it is surprising that market. I would have assumed this article would be talking about the weakening of the flipper mentality. That it's time to pull back a little bit, and that isn't necessarily what we're seeing now. It's on a national level, and I imagine that some of these markets like that we talk a lot about, Texas and Florida, for instance, are maybe experiencing a little bit more concern there, but nice to see that it's strong. And, I think most flippers would say the buy side is where you make the deal work. And so probably finding opportunities to pick up properties. And I'm curious as to how they do it.
Yeah, that's exactly right. Interesting article. Just definitely dive deeper in there for some data as you need it.
You bet. Well, very good, Jeff. That is episode 37 for us. Really appreciate the time here. And you are an administrator at the conference, and I know you're really busy. So glad we got an opportunity to sit down and get something put together.
Yeah, you bet. We'll go see what the Fannies and Freddies of the world literally have to say as they're speaking tomorrow at the conference. So we'll on we go.